Welcome, everyone. Today we are looking at Topic 8 in your SS2 accounting series, Company Accounts. This is an introduction to company accounting. A company is a business owned by shareholders. It is a separate legal entity. This topic appears regularly in your examinations. You must understand the nature of companies, the types of companies, and the preparation of company accounts. Pay close attention. Let us begin. First, let me explain what a company is. A company is a business that is incorporated under the Companies Act. It is a separate legal entity. This means that the company is separate from its owners. The owners are called shareholders. The shareholders invest money in the company. They receive shares in return. The company can sue and be sued. It can own property. It can enter into contracts. Companies are formed to undertake large-scale business activities. They are common in many industries. Understanding companies is essential for understanding company accounting. This is a key concept. Now, let me explain the features of a company. Companies have several features. The first feature is separate legal entity. The company is separate from its owners. The second feature is limited liability. The shareholders have limited liability. They are only liable for the amount unpaid on their shares. The third feature is perpetual succession. The company continues to exist even if shareholders change. The fourth feature is transferable shares. Shares can be bought and sold. The fifth feature is common seal. The company has a common seal that is used to authenticate documents. The sixth feature is capacity to sue and be sued. The company can take legal action. Understanding the features of companies is essential for understanding company accounting. This is frequently tested. Now let me explain the types of companies. There are several types of companies. The first type is a public company. This is a company that offers its shares to the public. The public can buy and sell shares. Public companies are listed on the stock exchange. The second type is a private company. This is a company that does not offer its shares to the public. The shares are held by a small number of shareholders. Private companies are not listed on the stock exchange. The third type is a limited company. This is a company where the liability of the shareholders is limited. The liability can be limited by shares or by guarantee. The fourth type is an unlimited company. This is a company where the liability of the shareholders is unlimited. The shareholders are liable for all the debts of the company. Understanding the types of companies is essential for understanding the different forms of business ownership. This is frequently tested. Now, let me explain the share capital of a company. Share capital is the money raised by a company from shareholders. It is the capital contributed by shareholders. Share capital is divided into shares. Each share has a nominal value. The nominal value is the face value of the share. The share capital is shown in the balance sheet as part of owner's equity. There are different types of share capital. The first type is authorized share capital. This is the maximum amount of share capital that a company can issue. The second type is issued share capital. This is the amount of share capital that has been issued to shareholders. The third type is called up share capital. This is the amount that the company has asked shareholders to pay. The fourth type is paid up share capital. This is the amount that shareholders have actually paid. Understanding share capital is essential for understanding company accounts. This is frequently tested. Now let me explain the types of shares. There are two main types of shares: ordinary shares and preference shares. Ordinary shares are also called equity shares. They are the most common type of share. Ordinary shareholders have voting rights. They receive dividends based on the profits of the company. Preference shares are shares that have a preferential right to dividends. Preference shareholders receive a fixed dividend. They have priority over ordinary shareholders. Preference shareholders do not have voting rights. There are different types of preference shares: cumulative preference shares and non-cumulative preference shares, participating preference shares, and non-participating preference shares. Understanding the types of shares is essential for understanding company accounts. This is frequently tested. Now, let me explain the difference between a company and a partnership. A company is a separate legal entity. A partnership is not a separate legal entity. A company has limited liability. A partnership has unlimited liability. A company has perpetual succession. A partnership has a limited life. A company has transferable shares. A partnership does not have transferable shares. A company is governed by the Companies Act. A partnership is governed by a partnership deed. A company can raise capital from the public. A partnership cannot raise capital from the public. Understanding this difference is essential for understanding the different types of business ownership. This is frequently tested. Now, let me explain the difference between a company and a sole proprietorship. A company has many owners. A sole proprietorship has one owner. A company is a separate legal entity. A sole proprietorship is not a separate legal entity. A company has limited liability. A sole proprietorship has unlimited liability. A company has perpetual succession. A sole proprietorship does not have perpetual succession. A company has transferable shares. A sole proprietorship does not have shares. A company is governed by the Companies Act. A sole proprietorship is not governed by any specific act. Understanding this difference is essential for understanding the different types of business ownership. This is frequently tested. Now, let me explain the Memorandum of Association. The Memorandum of Association is the constitution of the company. It is a legal document. It sets out the powers and objectives of the company. It is filed with the Registrar of Companies. The Memorandum of Association contains several clauses. The first clause is the name clause. This states the name of the company. The second clause is the domicile clause. This states the registered address of the company. The third clause is the objects clause. This states the objectives of the company. The fourth clause is the liability clause. This states the liability of the shareholders. The fifth clause is the capital clause. This states the share capital of the company. Understanding the Memorandum of Association is essential for understanding company formation. This is frequently tested. Now let me explain the Articles of Association. The Articles of Association are the rules and regulations of the company. They govern the internal management of the company. They are filed with the Registrar of Companies. The Articles of Association contain the rules for the conduct of the company's affairs. They include the rules for the appointment of directors. They include the rules for the conduct of meetings. They include the rules for the payment of dividends. The Articles of Association are subordinate to the Memorandum of Association. Understanding the Articles of Association is essential for understanding company management. This is frequently tested. Now, let me explain the directors of a company. Directors are the people who manage the company. They are appointed by the shareholders. They are responsible for the day-to-day management of the company. They make decisions on behalf of the company. They must act in the best interests of the company. They must act in the best interests of the shareholders. Directors have certain duties: the duty of care and skill, the duty of loyalty, the duty to avoid conflicts of interest, the duty to act within their powers. Directors can be held liable for their actions. Understanding the role of directors is essential for understanding company management. This is frequently tested. Now, let me explain the shareholders of a company. Shareholders are the owners of the company. They invest money in the company. They receive shares in return. They have the right to vote. They have the right to receive dividends. They have the right to attend meetings. They have the right to transfer their shares. They have the right to inspect the company's records. Shareholders are the ultimate owners of the company. They elect the directors. They approve the financial statements. Understanding the role of shareholders is essential for understanding company ownership. This is frequently tested. Now let me explain the advantages of a company. Companies have several advantages. The first advantage is limited liability. Shareholders have limited liability. The second advantage is perpetual succession. The company continues to exist. The third advantage is transferability of shares. Shares can be easily bought and sold. The fourth advantage is access to capital. Companies can raise capital from the public. The fifth advantage is professional management. Companies can hire professional managers. The sixth advantage is economies of scale. Companies can achieve economies of scale. Understanding the advantages of companies is essential for understanding why they are formed. This is frequently tested. Now let me explain the disadvantages of a company. Companies also have some disadvantages. The first disadvantage is complexity. Companies are complex to form and manage. The second disadvantage is cost. Companies are expensive to form and maintain. The third disadvantage is regulation. Companies are subject to extensive regulation. The fourth disadvantage is loss of control. Shareholders may lose control to directors. The fifth disadvantage is double taxation. Companies pay tax on profits. Shareholders pay tax on dividends. The sixth disadvantage is disclosure. Companies must publish their financial statements. Understanding the disadvantages of companies is essential for a balanced view. This is a key concept. Now, let me give you sample exam questions to prepare you for your test. What is a company? A company is a business that is incorporated under the Companies Act. State the features of a company. Separate legal entity, limited liability, perpetual succession, transferable shares, common seal, and capacity to sue and be sued. State the types of companies: public company, private company, limited company, and unlimited company. What is share capital? Share capital is the money raised by a company from shareholders. What are ordinary shares? Ordinary shares are shares that have voting rights and receive dividends based on profits. What are preference shares? Preference shares have a preferential right to dividends and have priority over ordinary shares. Explain the difference between a company and a partnership. A company is a separate legal entity. A partnership is not a separate legal entity. What is the Memorandum of Association? The Memorandum of Association is the constitution of the company. What are the Articles of Association? The Articles of Association are the rules and regulations of the company. Let me summarize everything we have covered today. A company is a business that is incorporated under the Companies Act. It is a separate legal entity. The features of a company include separate legal entity, limited liability, perpetual succession, transferable shares, common seal, and capacity to sue and be sued. The types of companies include public companies, private companies, limited companies, and unlimited companies. Share capital is the money raised from shareholders. Ordinary shares have voting rights. Preference shares have preferential rights. A company is different from a partnership and a sole proprietorship. The Memorandum of Association is the Constitution. The Articles of Association are the rules. Directors manage the company. Shareholders own the company. Companies have advantages and disadvantages. Understanding company accounts is essential for accounting. This is Topic 8 in your SS2 accounting series. Study it well. It appears regularly in your examinations. Well done.